overarching theme of the year has been, it's been volatile, right? There's been lots of fluctuation. Obviously, 2020 we had, obviously everything that we all experienced, and I don't want to keep dredging through that, but the overall theme of this year has been positive for the market. I mean, we're appreciating the year isn't over yet. Dow, S&P,
we still have
NASDAQ,
a little bit of time left. So, but basically to where we're at.
Yeah, I mean, basically everything, with the Dow being the laggard of the three, Dow, S&P, and NASDAQ are all north of 17%. S&P and NASDAQ north of 20-ish, right? So a couple of weeks left, obviously, so we'll still kind of figure out what we got here, a couple of days left, but
those are abnormal gains historically, right? Those are higher than normal appreciation.
Yeah, absolutely. Yep. So S&P historically averages about 10% per year, just about 10.3 pre-tax, pre-inflation annualized since 1926. So that's obviously appreciating. That's including all the crazy highs, but also all the low lows, right? All the the depression, the 1980s, the bubbles, the Black Mondays, all those things is a little bit north of 10. So we're double that, right? So, but just like a lot of the real estate world, don't forget where we came from. We hit the floor pretty hard, in March and April of 2020. So the recovery from there has been ongoing.
But what did 2020 end at? Just for that year, we hit the floor, then we bounced back. It was like a V-shaped recovery in 2020. So
yeah, it kind of went like Nike-ish. Yeah, it's hang on, let me get to.
Did 2020 end the year up overall after all of that?
Yeah. So
and was it as much as 2021? If you're saying 17+% potentially is where we're ending 21.
So we ended up with all-time high S&P. So we ended the year 2020 at an all-time high of 3756. We are round numbers north of 47. So we've gone up another, 25% since then. I think you and I have had this conversation before. From the all-time high on February 16th to the market bottom on March 23rd last year was 36%. It then took 6 months minus 1 day to go back to the February 16th high. So in 6 months, we fully recovered. And then it took 540 trading days to double that number. So February 16th was a record high. And then 500 plus days after that, we had doubled that number again in the pandemic.
I think that's the big fear, right? For people that are retired, maybe they're waiting for Social Security and they're trying to time, what they're going to do with, the money that they have in the market. They're fearing a 30-day, 36% drop.
Yeah. And if you're living on those assets and you're drawing down money, right? If you're taking, let's just, we'll make very generic round numbers. And obviously, none of these are, particular guidance, so to speak, but there's examples. You got $1 million portfolio. Historically, it can support between 3.5% and 4% withdrawals over the course of a 30-year retirement, and you won't run out of money. There's obviously, caveats to that, but that's historically kind of what it does. So let's pretend you're taking 3.5% of your $1 million portfolio, and you're using that to supplement your income. And now, within the course of 30 days, your $1 million portfolio becomes $700,000. Now you need a lot more than 3.5% to make up that money that you need, and you're compounding that problem. So if you need it short term, that's very scary. Which is one of the reasons we talk about, having places to put money that are not necessarily directly invested in the market, and having those other buckets, right? Those other buckets, of which real estate can be one.
Pat, we had a 36% drop that you noted in 2020. Was that the Dow or the NASDAQ? What was that?
That was S&P 500.
That was the S&P 500. So S&P 500 dropped 36% in a matter of roughly 30 days from February to March in 2020. To me, that's the big fear for people that have a lot of money in the stock market. They don't want to see a 30 or 40% hit to their portfolio. How likely is that happening again, whether it's 2022 or somewhere in the future?
I mean, so pullbacks, we all hear the words, right? We hear crashes, we hear corrections, anything. I mean,
that's a crash.
That's a crash.
Right?
Anything beyond 20 in the course of a quarter is considered a crash. I mean, pullbacks are fairly common. 10% to 20% tends to be fairly common, probably more than most people think. If you look from 2000 to 2020, you have a decline of at least 10% intra-year, 11 times. That's more than 50% of that 20 years. The average pullback at that time is 15%, right? So it's not uncommon to have 10, 15, even 20%. Something 30 plus has happened 3 times, not including March of last year, since 2000, and that was in 0102. That was the dot-com bubble. We all remember that. 08, obviously, the mortgage crisis, 47, almost 50% downside on the S&P, and then obviously this last March. All right, so those numbers, I mean, that's 4 out of 20 years that's happened. It's 5%. I mean, that's a fairly noticeable chunk. The likelihood of that happening in 22 and 23, I think, are much lower now. Certainly than they were coming into it. Don't forget too, we were hitting record highs, right? So again, the thing we talked about before the break, February 16th was the record high again. And you and I have talked about how many times, we show the charts, or we talk about the charts from your world of where things just keep climbing in a straight line up. There is a ceiling. I mean, eventually this stuff, corrects and pulls itself back. So I think in this case, next year, I don't see it. My view on it is you're not going to see a 30 next year by any means. You're going to have some rough days.
Pat, we were talking about flips there before the end of the break. Not the kind of flips that Martin does when you catch him at Oleo's, when he's all juiced up and excited. Not those kind of flips, but house flips when an investor is trying to make a quick buck, which is more likely to happen, like we talked about at the beginning of the show, in the S&P 500, where you can make a quick buck. But if you're looking to do that in real estate, you really got to do that in the flip game, right? Where you're buying a property, fixing it up, and reselling it. And Pat, the investor, the buyer who's actually going to be able to do that successfully in 2022, the one that did it successfully in 2021, is the one that's going to be highly educated on the neighborhood, on the numbers of what is selling, not just what the prices are, but what the floor plan is, what the finishes on those comps that have sold for top dollar in the neighborhood. Are they all similar finishes? Do they all have white cabinet, white countertops? And, what's the landscaping like? What are all the variables on these properties that are actually selling and for how much? And then can I get an undervalued piece of real estate in that area because it needs work, it needs attention, that the seller, can't sell it traditionally because it needs so much attention. And that person knows their numbers so well, knows how to line up the contractors, or, is doing some of the work or managing the process themselves, and is going to be able to make a spread on that money. There's a lot of flippers that are only making between 10 and 15% when it's all said and done. I think you really want to look at 20 to 25%. I do anyways. We're doing a flip up in Southington right now. We're just finishing it up. That we're going to hit 25% on that. But we knew the neighborhood really well. We loved the location. I mean, it was you're 2 minutes between 2 Starbucks. You take a left or right out of the neighborhood, you get to a Starbucks either way in 2 minutes. You've got all the shopping in that area. Downtown Southington, I think it was 6 or 7 minutes from that property. But in that neighborhood, the properties that were selling, we knew exactly what was inside of them. We had been inside those homes. And then we knew what it was going to cost for us to bring this property up to that level. We're not trying to exceed that level. We're just trying to come up to the level of the comps. And we bought the property well under market value. Okay, we found a seller who inherited the property, who didn't want to go on the traditional market because they had already tried it, and first-time home buyers couldn't get the financing because the inspection, there was all these different things that were wrong with the property. The inspection spooked out one buyer, one buyer financed. They just didn't want to go through that trouble because they were out of state, they inherited the property, and they just wanted to have a more seamless transaction. So cash, which is what we offered them cash. We offered them a 2-week close and no inspection. Hey, we're just taking the property as is purchased, because we knew our numbers inside and out. Nicole, who's been on the show in the past, Nicole White, who partners with me over at One & Company, she contracted the whole property. She was the general contractor, so to speak, on the renovation rather. So we knew what we were doing. We knew what it was going to take to get the property to a certain level. And we'll be listing that here right after the new year, early January, and we'll get 25% spread on that. But there are a lot of flippers that are doing scale that are, looking at 10, 15%. For somebody who's very inexperienced to be going into a flip with a margin of 10%, it's a lot of risk. One thing can go wrong and you're breaking even or losing money, right? And every flip, and here's the other piece of advice, anybody thinking about doing a flip or making an investment in 2022, anytime I buy a flip, I want to know that if I don't end up flipping it after the rehab, that I can cash flow and it's going to be very desirable as a rental.